Hello again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Monday, September 14th, 2020. Let's get to our topics of the day of our daily updates. Thanks for watching. So our first topic of the day frames up unemployment picture. It's actually interesting to look at. So markets don't wait for the employment to fully recover before markets go back up. In this morning's research from Strategis, there's 4 sample sets, if you will, and if you go into our daily comments down below of this YouTube video, you can get reference to what I'm talking about on a greater picture. I just used one right here of the time and place. Most recently was 2007 to 2008. In January 2008, we had a peak. The blue line here is our employment pictures by way of measured by non-farm payrolls. And what's interesting about this chart from 2008, January, was our peak of employment, right? And that's when the economy started going into the Great Recession, if you will, from the debt crisis that we had. The S&P actually in March of 2009 bottomed. Okay, so shortly after the peak, we bottomed. Payrolls didn't bottom until February of 2010. So several times, there's a lot of distance between now and then. Payrolls actually didn't exceed the prior January 2008 number until May of 2014. So that's a good 5 years, but better yet, the S&P 500 returned off of the lows 190% total return. So markets can go up even though unemployment's lagging, and there's a lot of effects to this. This is companies won't rehire back. They'll use new technologies as well to introduce that. You'll ask employees to basically take on and share the workload, if you will. There's all of the things that happen when economies go through recessions, but markets still go up. In fact, this is just one sample set. There's 2000 to 2006, 1990 to 1994, and then the early 80s, 81 to 85. Those exact same things happened, and it just took time for the economy to get back on its feet, to get back to full employment. But that takes years, not months. But markets take even shorter times to get and exceed prior market highs. And we just saw that earlier this year, a couple weeks back, as markets sort of exceeded their February highs of all-time highs in all the NASDAQ, S&P, and Dow Jones Industrial Average. So that's not by accident. This is history repeating itself, and markets looking through the employment picture and knows that the employment picture going forward is going to be stubbornly high, the unemployment number, if you will. But that being said, that still doesn't mean that corporations can't make money and business can't be conducted for markets to actually perform on a go-forward basis. So that's your little economic lesson right here, and looking at through history. And this time is probably not going to be different. It's going to rhyme, much like history always does. So rolling into our topic number 2, there is a reversion trade on. A few weeks back on my daily update, I discussed that the S&P 500, specifically, let's say the NASDAQ, because the technology companies, megatech, took a breather. They basically took a back seat to their leadership position, and they afforded, as I said before, we're going to retest some moving averages. That's the first thing to watch. We also want to watch credit spreads if they stay tight versus blowing out. That's a sign of stress. Those two things, we touched moving averages and we touched the credit, was just fine, intact. Those two were critical. Now, what happens? There was rotation within the market. And so I talked about those lagging S&P sectors catching up and catching a bid, if you will. We actually saw it play out over the last couple of weeks. We saw materials, discretionary, industrials, all catch a bid, which just means money's coming not out of the market completely, it's rotating. There's a great rotation, and we just had empirical evidence that that's happening. It's a healthy quality sign. So markets are consolidating right now, and that's something that we pay attention to. So the rotation trade is on and the consolidation trade is there. And that's a good thing. And we saw actually tech catch a bid once again. So as I talked about it, traveling up a mountain with the Schein family, we got 4 kids and my wife and I. So if we're running up the little trail right there, my kids are the technology sector. They're going to run up real quickly. They're going to have to wait for mom and dad, think materials, industrials, a few others, to catch up, even the financial sector. And that's what's happening. So we'll get up there to the top of the mountain all together, but they can't get up there without me, otherwise they're going to be in big trouble. So we're watching the rotation play out. So the great Peter Lynch from Fidelity Magellan, if you're a history of the markets or just a fan of investing, everyone knows Peter Lynch. He was the portfolio manager of Fidelity's Magellan, which is Fidelity's flagship fund. It was the largest fund, actually best performing mutual fund in history at the time over the course of Peter Lynch and at his helm when he was in charge. He had 25 plus year over year over year in the time frame that he was there. And Peter Lynch was one of the best portfolio managers ever, but that his track record actually proves that out. That being said, Peter Lynch, if you read his book, How to Beat the Markets, which I did, he talked about channel checks. He's like, he would have high school daughters and go to the malls with them and sit on the park bench at the high school and watch, or at the mall, and watch his daughters go back and forth and see what sort of trends the teenagers would actually, what was trending at the time in terms of retail and a few others. And then he would take that back to the office and have his investment research team sort of dig into it. He had some great stories. In fact, he had some great performance as a result of just following the empirical evidence of channel checks, right? Getting out there and seeing. Well, we have a same thing here that we just did. I was out there this weekend and I couldn't get over. We're still over about 110 degrees here in Palm Desert, California. And where our building sits is in a strip mall here. And I was coming to work and kids are gonna go to some of the stores here, and I couldn't find a parking spot. There were so many box retailers. Again, this is an outdoor mall, not an indoor mall, but we had lines out the door. They had lines out the door for people waiting to get in on every single one. I couldn't find a parking spot, literally, to get into my own sort of, where our work is, but sharing it with a bunch of retailers that are here. And these are high, big end retailer names. That would be like, well, where are these people coming from? They're going to stand, 10 to 15 people deep in 110 degrees in Palm Desert, California, waiting to get into sort of a home store here and that store there. It was amazing. It shows that the economy is live and well, even here in California. So, while they try to keep, somebody down in terms of staying at home, no one's staying at home anymore. I mean, the car wash guy across the street had 40 cars that were literally waiting to go through. So people are coming out. What does that mean, Rob? That is a channel check as it relates to the economy, right? That's going to translate into the third quarter GDP. Early estimates for third quarter GDP that we're in right now is going to be snapping back to about 20%. I would imagine we're getting closer to 30%, just upon what I know about California here and what I see with my own personal empirical evidence, my channel check here, just as a driving around the community. Our traffic is busier than ever. Now, again, California is still under the restricted guidance or restrictions, the hardest restrictions possible, California and New York. And if I see this kind of evidence with us being in the first tier of you're allowed to leave your house and go out for commerce to actually exist and people to actually leave. If this is just the first tier that we're in California, I could only imagine what's going to happen. Now, keep in mind, we had a very strong economy in January and February to start the year across the United States. We get hit with a shutdown, we get government stimulus. Checks are out there. There's, people didn't spend money on a few things like travel and vacations and stuff. There's that savings as well. There's a lot of economic stress for those who are unemployed, but those people did receive some unemployment stimulus, and over 40% of them, more than 40% of them, if you add back in, actually made more over the last 3 or 4 months simply by not working because the government assistance that helped them out. Now, on a go-forward basis, I talked about employment. The employment picture is going to be choppy. Unemployment is going to be very difficult and stubbornly high. But the economy, as measured by M2 money supply, is up 23%. M2 money supply, if you remember, it's just the amount of deposits year over year that are in the banks right now. And the Federal Reserve pays attention to it because it talks about sort of, does the consumer or do businesses have money in hand? Therefore, can they actually spend that? That's very important empirical evidence. We pay attention to that for just that fact as we manage portfolios going forward. It's also a sign of the U.S. economy. If a consumer, we know this, as a U.S. consumer, if somebody has $1 in their hand, we are a generation, we are an economy, if you will, in multiple generations that if that dollar is in the U.S. consumer's hand, they're going to spend it. So we've got 23% year over year money supply. We know there's money in the bank. We got people lined up in 110 degrees. You can't find a parking spot. Our California is even shut down. So you're not allowed to leave your house, but commerce is happening. And this is good because people are actually not just shopping online anymore. They're actually leaving their houses. So commerce is happening. That is going to translate into a huge monster GDP number. We're going to come back to this day and time on September 14th and see if I'm right, but it's a pretty good prediction just by the old Peter Lynch channel check of what I see around my personal community. So thanks for watching today, and looking forward to next time. And don't forget, later this week we have our election edition. You know, we have less than 50 days left of the election, so we have to talk about portfolio positioning with Robert Stein, First Trust, and he's going to be here with us Wednesday. So be sure to sign up for that. Thanks for watching. Take care.